quick overview of a cash flow statement. So we have inflow, receipts, if you will, money coming into a business, usually from sales of goods or services. So if you're a supermarket, from all the sales of all the products you sell. But it could also include money from investors, so capital that's put into your business by investors, like sale of shares. So 1, sales, 2, money from investors, 3, loans from banks, for example, and 4, although it's not included at the top of this sheet, look, it could be sale of assets. So when you sell things like machinery or vehicles, that would also be money flowing into your business, which would go under cash inflow. Sales, loans, cash from investors, sale of assets. So if inflow are your receipts, the outflow is everything that a business spends. So it's got all of your fixed and variable costs in there, your wages, which is sometimes called payroll. That's all the money you pay to employees. Payroll, transport and delivery costs. If you are a supermarket or a shop, you have to buy stock in order to sell it. So that's your stock, utilities, including your gas, electricity and water, rent, etc. These are all called outflows. And you add those together and come up with your total outflow for each month. That could also include loan repayments and interest on loans, if you have loans, of course. So the really important first calculation is called the net cash flow. It is the total inflow, so the value of all of the receipts, minus the total outflow, which in plain English means receipts minus what you've spent. In this case, 32,000 minus 28,500 equals 3,500 in October. So that's the net cash flow for October in the blue box. Now we've got an opening balance in October of minus 3,000, but that's because of what happened in September. The opening balance means all of the cash, money, coins, bank accounts that the business has by the end of September. But we haven't got the data for September, so there's no calculation on here for that minus 3,000. That's come from September before. That's called the opening balance. Notice how the opening balance is the same as the closing balance for the previous month. I've highlighted that with the arrows. Look, I'll say that again. The closing balance of one month becomes the opening balance of the next month. Quite simply, the way to work out your closing balance, so the value of all of the money, coins and money in banks that you have at the end of a month, is to add the net cash flow to the opening balance. In this case, and look, they're in a blue box, 3,500 plus minus 3,000 equals 500. So you're adding the net cash flow to the opening balance. If you look at November, it's minus 900 plus 500 equals minus 400. So we had £500 cash at the start of November. We had a net cash flow of minus 900. The balance by the end of November, minus 400. Practice that for December and look at the link between the three numbers at the bottom of the cash flow statement. It's really, really important. Most businesses do this each month, but some cash flow statements could be weekly, but it's probably easier to do it each month, because generally you pay people like your suppliers and you pay your staff on a monthly basis rather than a weekly basis. That's generally the rule. Okay, study these sheets and in the exam be ready to fill in gaps. What they often do is leave some of the calculations at the bottom blank and ask you to fill them in. Okay? Practice it, act with confidence, get it done.